Dear students, today we're going to learn about investment portfolios. It's one of my personal favorites, so I hope it will be yours as well. This video will cover portfolio mathematics and investment portfolios. The Intelligent Investor by Benjamin Graham is one of the most famous investment books that started modern portfolio management. Benjamin Graham influenced investors such as Warren Buffett. Benjamin Graham was actually Warren Buffett's professor and also a member of his board of directors. Benjamin Graham, in many ways, was the founder of value investing. To look at the history of portfolio management, it really started out with Adam Smith and his invisible hand. He described how the world works like and how it looked like, and wrote a lot of good books and had really good seminars on investing and international trade. Now, David Ricardo took that to the next level by explaining comparative advantages. Now, naturally, John Maynard Keynes, who won a bunch of Nobel prizes, well, he really just won one for modern portfolio theory. He could have probably won one for many other things that he did. Really influenced how governments are run in the Western world. Benjamin Graham learned everything from the professors before him and then wrote The Intelligent Investor. Another individual that learned a lot from Benjamin Graham was naturally Milton Friedman. He won a Nobel Prize for macroeconomics. Later on, Markowitz received the Nobel Prize for modern portfolio theory, and later Jack Trenner, William Sharpe, and Littner and Molson developed all kinds of very sophisticated and modern portfolio theories that are used today. All these individuals helped shape how we do finance and interpret economics around the world. Morningstar has a very sophisticated portfolio management system. Lots of financial advisors use it to manage their clients' money. Morningstar offers 3 different types of membership. 1 is free. 2, you're an individual and you just want to have a simple portfolio management tool for your investments. And the 3rd one is a souped up, complicated one that is used by financial advisors. And that one costs a lot of money. We'll take a look at the website for Morningstar. But here's a simple list of things that you can do to actually start putting in your portfolio into Morningstar. 1, you go to morningstar.com, you click on the portfolio tab, you create a new account, you enter the message that you want to use when you enter a new portfolio. You click the type of portfolio, you enter the ticker symbols, you enter the number of shares, you pick a date, and you will be given information. They have everything stored in data and stuff like that. Not your information, but if you just know the ticker symbol and the date, you can either use a date that they provide or the exact price that you bought the stock for at that specific date. And then you just name your account and you're done and can analyze your portfolio. Morningstar is a very powerful portfolio management tool. I recommend that you sign up for a free account. Once you have signed up, you'll be able to gain lots of good information and an amazing amount of resources. So you can learn all about investing. You can look at different types of custodial accounts from so that you can do the correct tax planning, personal finance, save for college, save for retirement, invest for in retirement, gives you lots of research, and not only on mutual funds, stocks, and ETFs, but also bonds and other investment strategies. Now, a good part is the portfolio side. Here you can create your own portfolio by clicking on Create New Portfolio, and then you have to name it. And then once you do that, you can always modify whatever all the holdings that you have in that portfolio. You don't have to do it all in once. You can always add holdings afterwards. You can have different types of views. In this case, I typically create something that a view that I call the Kelly view right here, and that has all the different items that I would like to do research on, that I like to initially look at. You can export it to Excel. You can print it. You can also navigate through different types of portfolios. And here's one that I created for exchange traded funds. And if you want to look at performance, you can click there. If you want to click on X-ray, it gives you a good idea how the asset allocation of this portfolio that I now named as aggressive. Now I'm an value investor, so I'll probably want to be up here, and it will let me know how much cash I have, how much is in US stocks, which is the majority of it. Some of it's in bonds, some is in foreign, and it can give me a good idea of the different areas that I have invested my money in when it comes to this particular portfolio. There's other tools that you can use where you screen for funds or stocks, or look for similar funds or anything like that. Let's take a look if I can get this one up and running. So in this part, you would enter the ticker symbol and find it that way, or you look at the other things that you want to compare. If you want to learn more about bonds, you can go on to the bond side and learn more about that. Even on ETFs and other market tools. So Morningstar is an excellent website and portfolio management tool that I do recommend you to use. Otherwise, you can always have your financial advisor use Morningstar for you, in which he or she will charge you a bunch of money. But I say be in charge of your destiny and learn and do the homework and make sure that you have a diversified portfolio that works for you. One of the tools that Morningstar uses is to help you diversify your portfolio. It will actually do a screen and say, this is how much money you have in industrials, this is how much you have in cyclical, this is how much money you have in information technology, and so forth. Because you want to diversify in the right way, you want to make sure that you do it according to certain tools that are available for you. One thing that they have found is that if you look at the risk versus it's really risk return, but if you look at the risk given the amount of stock that you have, the more stock you have, the lower the risk. But if you have only Swiss stock, then the risk is high. If you only have US stocks, then it's a little less. Now, if you mix Swiss and US stocks, they found that the correlation is very low, and that means that an international stock portfolio is significantly less risky. The reason why it's less risky is because you spread the risk on different countries. So that means that you have less political, institutional, and psychological factors that affect the security returns by having the investments work in different countries. Most countries don't have the same disaster at the same time. The difference is when you have like a virus that goes pandemic. Now we have a global problem, and then you have different sets of rules to pay attention to. That's why it's important to know all the different risks that are involved when it comes to investing. So in the universe of investing, there's ways, and Morningstar does this for you, plot all these different investments in a portfolio. There's all the different types of possibilities for a portfolio. And when you run the statistics, you can get a efficient frontier like this. And when you plot that out using the risk-free rate of return, in this case, typically the 10-year Treasury notes from the federal government, the U.S. government, is plotted out on the expected return as a risk-free rate of return, and here you have risk. So then you would plot this line upwards, and where those two meet, where they're tangent, that's the best allocation given the risk for that portfolio. Now, what a lot of portfolio managers claim and state, and some are very successful and some are not very successful, is that they can not only take the same risk as the general market, but they can generate a positive return above that. And that's called a positive alpha. A negative alpha would be getting less return for the same amount of risk. So this is why people hire portfolio managers, to actually give them a better return. Now remember, that return needs to not only cover the fee that the portfolio manager has, but need to surpass that fee and actually earn you extra money. Otherwise, it does not make sense, and then you're better off index investing. So by looking at the different correlation of risk, you can compare it to Australia, France, Germany, Japan, Netherlands, Switzerland, United Kingdom, and the United States. So actuaries would run different statistical numbers on what the correlation would be if you would invest in another country. So assume that you have a part of your portfolio in the United States and the other part in Switzerland. What would the risk look like in that situation? So that is a good thing to do, and take a look at it and see how does the correlation work, and will it benefit your portfolio to minimize risk while maximizing return. Another way is, instead of buying a stock in the on the stock exchange in, for example, England or Germany or Japan, some of these companies from foreign countries would list their stock cross-listed in the United States, for example, on the New York Stock Exchange. They typically do it in something that's called an American Depository Receipt, or an ADR. That way you can use US dollars to buy stock in Sony, and you don't have to take a currency risk in the same way where you would, in the old days, maybe have to buy Japanese yen first, and then open an account in Japan, and then from there buy Sony on the exchange, and that would be very tedious and very expensive. So the positive thing when you have a stock listed, cross-listed on different exchanges, is that it allows a company to have a greater access to the capital markets. You don't always have to buy stock. You can also buy what's called exchange-traded funds, ETFs. iShares.com is one company that offers a bunch of index funds that are listed as ETFs on the stock market. You can buy and sell them just like a stock, but the difference is that they're a pool of investments. So the Eurozone ETF will give you access to the largest companies listed in the European Union. You can also just focus on ETFs that invest in the largest companies in Germany, United Kingdom, Switzerland, Spain, Italy, France, Turkey, Sweden, around the world. You can actually buy one ETF and get access to an entire market like China, India, Brazil, Russia. So these are the ticker symbols that you can go to Yahoo Finance and just enter these ticker symbols and find out all about them, or go to your custodial account and enter the ticker symbol there and find out what they have to say, or you simply go to iShares.com and read the full prospectus. So what is an ETF? Well, an ETF is a legal entity that takes money that comes in. So when someone invests money, they receive money and they take that money and then go out and buy stocks in the different indexes that they have created. Now that costs a lot of money to do something like that. So if you buy an ETF and you have $100 and they cost $1 a share, and you get 100 shares for those $100, now that's a fraction of shares, okay? Fractional shares. Just like if you would use a trading platform like Robinhood or Fidelity, or I think even Charles Schwab might even have a fractional shares platform. So they pool all the money and take that and then buy the full amount of shares together. So all this costs a lot of money, and to break even in one of these ETFs is typically around $26.5 million. That's just to break even. And that's even before they start paying themselves. So some of these fees are that you have a bunch of fees on for assets under management. So they might charge you 75 basis points or 0.75%, so not even 1%, to have an international fund, for example. That needs to cover the legal fees for a bank holding company, the listing fees for the exchanges, fees for auditors and reports, and maintaining a website with all the data and information sent to the SEC. So you have fees for a bank holding company that acts as your trustee. You have custody services and all kinds of other things that go in. So all these fees trickle down and cost a bunch of money. So when you see a fee of 0.75%, these are all the people that get paid for doing the work for you. Now, if you create your own stock portfolio, you will probably have some sort of home bias in your portfolio holdings. A few things to pay attention to is that there's domestic equities may provide a superior inflation hedge. And yes, that's probably a good reason why you want to do that. That's why you have a bias for it. Another home bias may reflect institutional legal restrictions on foreign investments. So it's much easier to just buy something in your home country that's listed on the New York Stock Exchange. Another home bias would be the extra taxes and transaction challenges that you might have when you buy stocks in a foreign market. And that's why there's a lot of reasons for a home bias. So home bias really refers to the extent to which portfolio investments are concentrated in domestic equities. For example, that you have all your money invested in US-based companies. A recent study of brokerage records of tens of thousands of U.S. individual investors shows that wealthier, more experienced and sophisticated investors are more likely to invest in foreign securities. Now, I just showed you that you can actually invest in ETFs that actually invest in the stock market for you on your behalf. You have to make the decision when to buy and sell, but they will actually say these are the companies that you will invest in Russia or China or Brazil or India and so on. Another thing that was found when it came to doing research on portfolio holdings and home bias was that when a country is remote and has an uncommon language, foreign investors tend to stay away. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.